Good morning, everybody. For those of you who are still on the call, I hope you're hanging in there. Not much longer to go, and then you can go and have a cup of coffee. So a quick update on Rainmaker. I've got just a very few slides, and I think it's interesting to reflect back. It's been a hell of a tough time, as we know, for equity market investors in South Africa. Looking through the screen at a lot of you, I think you probably. Many of you and many of your clients may even have completely lost faith in the South African equity market's ability to grow and to protect the value of the real value of savings. You can see it clearly in this chart, which is the all-share index. Going back about 7 years, we were trapped in that 50 to 60,000 range for a very long time. And even within that, as you know, unless you'd owned pretty much only a handful of resource stocks and maybe one or two sort of unusual other stocks, you look pretty mediocre and generally pretty weak and pretty poor. And then along came COVID in Feb of 2020. You can see that massive effect on the market, the fastest crash experienced on the stock market in history. Equally so, the fastest recovery. And you can see by the end of 2020, the market had recovered that. And then, lo and behold, in 2021, we've pushed up very strongly. And so far this year, only a few weeks in, we've continued to have quite a strong run. And in that context, the obvious question is, I think the market has brought back some confidence in it. I imagine for many of you, your life is a little bit easier in going and reporting back to your clients and being able, for the first time in a long time, to be able to reflect and report on very attractive and certainly strong inflation-beating returns out of our domestic market. And hopefully that's buying back a little bit more confidence in this animal's ability to protect and grow the real value of savings. The obvious question is, having seen how this has evolved, and it's the title of my presentation, is there any gas left in the tank? And I hope to give you a couple of points around how we're feeling about that and how that's looking for Rainmaker. Another quick thing is just looking back at what that performance has been. Forgive me, I'm a bit of an old bully now. I need the glasses to see this at this distance. But the fund had a very, very satisfactory end to the year in the third quarter. The returns for the year looking a little bit better. We acknowledge absolutely in the sort of medium term where Rainmaker looks a little bit looks mediocre at best. But we're working very hard to turn this around. And as Dave has already reminded you, we had that change in the mandate back in September of 2020. And we've used the period initially to get a reasonably substantial offshore weighting. We didn't want to muck around and find ourselves struggling. The rand then went through a strong period of appreciation in the first half of 2021. And the chart on the right just shows there, the dark green line is the rand-dollar exchange rate. And then, interestingly, note the inverse correlation of it to simply the palladium price, which is the one that where it's most clear to see. And as many of you know, we had this very, very strong period of commodity prices, particularly PGMs, in the first half of last year. That had a very positive effect on the South African trade balance, a lot of money pouring into the country, a lot of people buying rands. But note how dramatically that turned in the second half of last year. As those commodity prices have rolled over, the trade balance is a lot less favorable for the South African currency, and we've seen that weaken. And by the time we got to the end of June, we had got Rainmaker right up to its full 30% offshore allocation, which is where it remains today. And we used that ongoing strength in the first half of last year to gradually and continually increase the total offshore exposure in Rainmaker to the point we're now at the maximum limit. A couple of other points, just looking at the returns for the year. Some very, very strong returns from some quite big positions in the portfolio. I would draw your attention just to the average weight in the far right-hand column, and you can see some big punchy positions in the fund really coming through very strongly. Another point I'd like to emphasize is our sort of mid and small cap ability to pick stocks. You can see there Royal Bafokeng Platinum, which is something that's held across our funds. For those of you who are also entrepreneur followers, you'll know it was the single largest holding in entrepreneur. Lovely to see that in Rainmaker, also in the top 4. I'm also very chuffed to see our stock picking ability in the global space, clearly adding value, and not just in a particular sector. Yes, there are 2 tech stocks there in Google and Microsoft, but you'll note also further down AutoZone and Thermo Fisher. So a very nice contribution from a variety of sources driving performance in 2021. Always have to be honest and frank about we don't get it all right. You can see the fund did get hurt from the common prosperity theme. 2 of our big positions there, but notably the Naspers process combination, which we had moved very aggressively in the fourth quarter of 2020 and the beginning of 2021 to reduce our exposure because of our concerns around this issue, but we didn't sell it out completely. They remained both, reasonably material holdings in the portfolio. We believe valuation is still very supportive. I overheard some of Omri's presentation a bit earlier, so you've heard the remarks he made about what our firm's view on those companies are, and I'm not going to repeat those. And a couple of other smaller positions on the global side, particularly in the tech space. You can see Activision Blizzard there were a couple of the detractors. So full disclosure, there you can see the top and the bottom contributors to the fund's performance. And happy to take questions you may have on those specifics. So that's all enough about the rearview mirror. In the context of this bounce we've had, and my question, is there anything left? Is there any gas left in the tank? Our view is that answer is an unequivocal yes. We think valuation in our domestic equity market, notwithstanding the performance we've had, is very supportive. You will see the dividend yield on the left-hand side there at 4.5%, closing on 5%. In a historical context, is still very attractive. If you look at PE ratios broken up across the various sectors, although the market overall is at about 11.5 odd times earnings at the moment, it's being pulled down by the resource space, and you can see that's that sort of lighter green line, whereas the financials and industrials are slightly more expensively rated. The big question clearly to be is, given the run and the huge growth that we've seen in many of the resource companies' profit streams and lower commodity prices, what is the outlook there? And we're certainly reasonably circumspect about some of those, but in many others still quite positive. I would concur with some of the points that both I've heard Omri and Saul make over the previous half an hour or so about the outlook for commodity consumption out of China. Still reasonably supportive. So how is the fund positioned? Let me start. If you start at 12 o'clock and we move around in a clockwise fashion, the first point I'd note is that from this you'll see clearly almost 3/4 of the fund is essentially rand hedged, either through the actual direct global equity exposure, which is 29% plus another 1% in cash. Then we've got our resource exposure. You can see there quite a punchy weighting, around 18 or 19%. Then the Naspers process combination, British American tobacco, and in addition to that, some auto calls at the end of December was 7%. Some of you who follow the market more closely will know we've had a very strong run out of this part of the portfolio already so far this year. Checking this morning, it's now up to 8.5%, in fact. Then some other South African rand hedges that are listed here. For example, there would be some Richemont that we own directly here. And then top left-hand part of that pie chart is just, you can see relatively limited exposure to our domestic SA financial and industrial stocks, which is about 1/4 of the portfolio. Our key stock picks on the domestic side. First of all, on the right-hand side there, you can see those list of stocks. I'm happy to go into any detail around any specifics there. What you'll note here is a very clear quality bias. So while I would concur with some of the remarks that I heard Saul make in the prior slide about the attractive valuation of some of our financials, our preference is for the business that we think is going somewhere, that has momentum behind the franchise, even though it trades at a premium, because it always has done. And so we would much prefer a FirstRand rather than an ABSA or Investec, where we don't think the zebra is really that capable of changing its stripes. The other good examples there of sort of domestic businesses that we think have got great attractively valuations and where there's a bit of momentum behind them is a business like Bidvest. And Santam is one which we think has got some catching up to do as it recovers from the hangover of the business interruption insurance issues around COVID. For your interest, I've also put the largest positions that we have. These are all held directly, I think, in the fund from the global perspective. You'll know my colleague Steve Minnar, who works very closely with me, has primary responsibility for this, although I work very closely with him. And you'll notice here, I think, a very interesting balance between, some sort of higher growth businesses in the technology space that are certainly looking a little bit more attractive from a valuation perspective to more consumer-oriented businesses, both in the US and some with international exposure in their operations as well. As a sort of a wrap up, the sort of key issues around how the fund is positioned. So we are at maximum offshore. We've had the benefit in the short term over the last 6 months of the weakening currency. I'm sure Lara explained our view with respect to the rand-dollar exchange rate, which we think is unlikely to weaken substantially from here. But longer term, we believe the structural issues that still exist within South Africa are likely to or do keep us medium-term bearish on the direction of travel for the rand. So we're not looking to reduce our offshore exposure at this time. On the big Naspers process combination, we think Tencent has lower growth prospects than perhaps it did previously on the sort of required reinvestment that's come through, driven by the common prosperity demands of the state and of regulators. But we expect the sort of investors' fear of this impact to ameliorate already in the first half of this year. And of course, the valuation of that business is at the lowest it's been since the company was listed. And then we have the NAV discount structural issue here in South Africa, which remains an interminable problem. It's a massive frustration to shareholders. We don't think that, given the reticence that the board and the management of the company have displayed in dealing constructively with the issue. In fact, every effort that they've made to date have failed dismally. The only vague glimmer of hope that you may have, which Omri referred to earlier, is that the CEO is buying stock over and above what he's required to in terms of his incentive package, which is obscene. British American Tobacco, here we feel this has been a real drag on the performance of the fund for some time. It's been trapped in a very, very lowly valued position for about 5 years. Finally, it seems our patience is starting to be rewarded. It's had a nice pop over the last month or two. But there's still a substantial gap between that and if it simply moves back to its sort of medium-term average of relative and absolute valuation levels. We believe we've got some very strong catalysts coming up on the 11th of February when the company will report its full results for the year to December. And that includes a clear guide to profitability on their reduced risk product portfolio, a recommencement of a share buyback program, and all the debt ratios moving within their long-term guided ranges. And it appears the market is starting to take notice of this, but we think there's still substantial upside on that position, and it's reflected in the size of the holding that we have. Some key local picks we think are at very attractive valuation levels relative to their history. And although the growth prospects are reasonable, we've seen the kickback in profit levels from the very depressed COVID levels of 2020, which were reported in 2021. We're not expecting huge macro support here in South Africa, but reasonable, and valuation is still very attractive. So growth is okay, valuation attractive, and a business like Bidvest is a great example of a package that has all of this in one place, combined with a very competent management team and a high-quality franchise. On the resource side of things, we prefer defensive exposure into commodities where we still see upside, copper and diamonds. I don't know if you saw, De Beers have pushed up their price of diamonds by 8% for the first sight of this year, and that's going to be interesting to see what the outcome of that is likely to be. We also like oil and thermal coal plays. Just on the supply-demand structural imbalance, all exacerbated by the world's fascination and fixation around pressuring everybody into a squeaky clean ESG profile, which we clearly have to be aware of, but our approach is to engage and to work with the firms rather than simply exclude, and we see some great opportunities there. PGMs, the big question here is how quickly demand will recover from being able to be appropriately supplied from a semiconductor shortage perspective. We're working in a steady recovery from starting already in the first half into the second half, and we'll be watching that very closely, the extent to which that actually occurs, because right now in the short term, the equity prices relative to where those PGM prices are discounting that demand recovery happening quite quickly, and if it doesn't, I think there's some downside for those stocks. Putting it all together, I hope I've given you a reasonable perspective of the fund, but I would say we move into 2022 despite the strong run that we've had over the last 2 years, feeling confident that 2022 will be a year of reasonably good returns for South African equity market investors.
Done. Thanks so much, and really appreciate your presentation today. And thanks, we have had a few questions come through from the audience. And the first one is, you did allude to your kind of more SA-focused mid and small cap type stocks, and maybe some of them fit within that 26% or whatever it was in your SA financials and industrials. The question was more around in terms of, you made mention of them, of course, but then in terms of the risk-return profile of some of these companies, do you have conviction in any of them that they could almost creep into a top 10 type holding? I don't know, because I'm trying to reflect also on some of the things that Omri was saying around, and Saul as well, around SA valuations looking quite attractive on a global point of view. Global investors will go searching in yield, and I guess this has some feed through for those local counters as well.
I'd like to think so, Dave. I would certainly say we've got the flexibility, notwithstanding our total AUM, to be able to achieve that. And having, the discipline and the focus of the work we do on Entrepreneur is a very, very positive engine within our process at Abax. So I look at some of the larger positions in Entrepreneur, which are also held in Rainmaker, and I would say, if the appropriate one came along, yes, you could see it. I think probably a good example is a business like AVI. It's a great high quality business. The valuation is very attractive. Unfortunately, growth in the consumer space for those that are branded consumer products, it's pretty hard to come by for the time being.
Yeah.
So that's an example of one I think, in Rainmaker is kind of on the verge of that. So short answer, yes.
Okay, great. And I guess AVI also in food production as well as, I think, as clothing and shoes as well in those typical brands.
Yes.
Okay.
And we've, there was a deal almost last year where Mondelez tried to buy their snacks business. So I mean, they have, well, you'll all be familiar with Baker's biscuits. It is an iconic South African brand, not only South African, but they've built a phenomenal platform, a distribution platform into Southern Africa. And Mondelez, who own Oreo, if they want to have a proper African franchise, there is only one asset to buy on the African continent. And if they want it, they're going to have to pay up. And I think my understanding in speaking to the CEO post the withdrawal of the cautionary was that it was ultimately just a price discussion. There's no disputing the value of the asset.
Yeah, I think there are a few people on the call who all played Baker's Biscuit mini cricket at some point
Sure.
in their childhood. I don't want to go into the topic because I have another question here, but it also speaks a little bit to some corporate activity in that space as well. I think there was something on Tongaat this morning that I may have read. I believe there was Liberty, Imperial as well, with DP World coming in there. So in terms of entrepreneur fund, there's obviously opportunity in the sense that these guys will pay a premium on certain stocks,
Yes.
but also your universe gets a little bit more condensed as some of this activity takes shape.
Yeah, I think that's, you can't worry about that too much. Just that's the inevitability of a flexible market, and you just got to roll with the punches and live with that. But you allude to a good point. Last year we've had, between Entrepreneur and Rainmaker, I think we've had 5 or 6 takeouts, which have been great lifts. Or the RMI thing was more of an unbundling. And an unlock of trapped value. Clearly, the giant golden, pregnant goose would be if there was some progress on the NUSPAS discount, which is 60%. Which I think is unlikely to happen in the next year, but must happen at some point.
Yeah.
So there's still lots of opportunity in that regard.
Okay, thanks, Anton. We've got time, I guess, for one more question here. So it's come through in a few presentations today that the US is obviously trading at quite expensive levels. If you look at some of the names in the global portion of the portfolio, there are some of those sort of household US big names.
Yeah.
So the question is more around how come your offshore holding is largely on those popular US names, but maybe give some context to the offshore component of the fund and where some of that regional exposure is currently at.
Yeah, that's a good question. I don't actually have those exact numbers at my fingertips. So the points I would make is where we own some of the higher growth, more well-known technology names. Microsoft is a good example. Google and Amazon are 2 others. These are very high-quality franchises that we still believe have substantial, runway for compounded growth.
Yeah.
And where the valuations are reasonable. You're not going to see any of these sort of crazy. We don't own Tesla. We don't own, a lot of these SPAC startup businesses. We've looked at some very interesting business models. There's a great one called Freshpet, for example, in the US. But the valuations are just, too crazy for us that we feel comfortable with as, pretty conservative South African investors. Having said that, it's a very balanced portfolio. We own some tech, we own a lot of consumer stocks, we own 2 materials businesses in the US, Martin Marietta and Eagle Express. And these are simplistically put, like the Afrimats, which is held in Entrepreneur of the US. A little bit different in some respects, and obviously they don't have the iron ore that Afrimat has. And these are very attractively valued businesses where we think on the infrastructure investment theme in the US, there's good growth, and the valuations are sort of low double-digit multiples. So, even on the international side of things, while we might have Samsung, on the technology space, actually very attractively priced business, only trades at about 11 times earnings. It's the single largest position we have. So we are valuation cognizant and concerned and worried in the context of what the growth is that we expect to come from those businesses. We're not afraid to pay up where we think there's, a great long-term, pathway of growth. But we're sensitive to valuation, and that international component of the fund, I think, is very well balanced. It's not a proxy for a US tech unit trust or something like that.
For sure. I know Steve's also bringing in some of his better calls from your global equity fund, which has kind of quite a long track record. And moving out of the US, you've held some sort of European stocks maybe linked to some of the infrastructure spending going on there, the luxury brands. Similarly in China, I think Li-Ning is kind of an upcoming brand there as well.
Yeah.
I say upcoming, they're probably fully entrenched at this moment, I'm sure. So
we think that theme has got a lot of legs still around athletic wear, more broadly defined, and that the very strong brands we think continue to get much stronger. So we own Adidas, we own Puma, and we own Li-Ning. These are 2 European and one Chinese business. We haven't owned Nike, but we do follow it very closely, and it's actually done even better.
As we know, some of those brand names are absolutely priceless. So. Anyway, thanks so much for your time this morning, Anthony.